market believes that this is not something that will be long lasting and that it might end up being concentrated in certain neighborhoods within these larger cities and therefore not adversely affect the reopening of these companies in particular or the reopening of the economy in general. The market continues to work its way higher, possibly because there are just a lack of attractive alternatives. I still question how high the market can go because of the valuations that it is sporting right now. We're looking at a price to earnings ratio of 24 times the next 12-month earnings, which is actually more than 60% above where we were 2 months after the bear market ended in 2009, and about 35% above where we were 2 months after the bear market of 2002 had ended. So even to say that, well, we're just coming out of a bear market environment, it still appears as if the market is expensive and possibly in search of a catalyst, and maybe the riots will serve as that catalyst. Usually the market does not like uncertainty and the changing of horses in midstream or the replacement of a sitting president who has the ability to be reelected. Should that not come to pass, I think Wall Street would be a bit shaken by that. Also, I think depending on who ends up being the Democratic nominee, obviously we believe it's Biden, but then important also is whom does he choose as his running mate? If that person ends up being very left-leaning, very socialistically leaning, I think that a lot of people on Wall Street would be concerned by that, especially now that President Trump is seemingly becoming more vulnerable to a defeat. We should prepare for a second wave. And I think that while that is therefore a very good likelihood, Wall Street right now is focusing more on the very near term, looking to benefit from price action as it relates to second quarter, third quarter earnings, and indicating that maybe we won't be seeing the minus 45% in earnings for the second quarter as is currently forecast. Maybe we won't see the more than 25% decline anticipated for the third quarter, that actually we could end up seeing a decline that's a lot shallower than that. And maybe that is what Wall Street is playing on. And we'll have to wait to react to the election a little later on in the year. With the market being up almost 40% from the March 23rd low, a majority of the advances have already taken place. But usually in the 6 months after a bear market bottom, the three sectors that fell the furthest tend to be the best opportunities. So they would be energy, financials, and industrials. Also, the 10 sub-industries in the S&P 500 that fell the furthest make for the best investment opportunities 6 months ahead. So there would be companies, 5 of those sub-industries were in the oil and gas area, and you also had airlines, you had household appliances, motorcycle manufacturers, so many of the groups in the consumer discretionary space.